Good day, I'm Abolore. On today's episode, we'll be looking at the concept of profits in economics. So, when we say profit, we also mean gain. That's another word that can be used side by side with the word profits. So, by profits, we mean the financial gain a business realizes from merchandise, and that's from buying and selling, or that an individual earns from investments. Although, as to the investors, they will often regard profit as return on investment. So, when we say profit, basically, it is actually net of two things. That means when something had been deducted from something, and that is when your total cost had been deducted from your total revenue. So to get your profits now, it is total revenue less total cost. Now, I will come back to talking about, perhaps in a second or two, I'll come back to talking about profits extensively. But in the meantime, let me quickly run through some of these terminologies, which will enhance and facilitate your understanding of the topic we have to talk about as regards today's episode, which is profits. So let's start off with supernormal profits. So when we say supernormal profit, it means excess profits, and it is the profit level above the estimated or the expected profit for a business organization. So, uh, uh, let's say, for instance, the profit forecast for a business in a financial year by the management accountants. Let's assume that's to be 50 million naira. That's the profit forecast by the management accountant of a business organization in a financial year. And the business ends up realizing or making profits of, let's say, 200 million naira. 200 million. That's the actual profits the business made in this financial year. So what this means is that the business were actually expecting 50 million as profit for that year, then they end up making 200 million. So the difference between these actual profits and the estimated or expected profits is supernormal profits. So supernormal profits means excess profits. And to get to supernormal profit, it is basically the difference between your total revenue less total cost, or the difference between total revenue and total cost. But the difference you're going to have when you less your total revenue, or when you less your total cost from your total revenue, is profit. But by supernormal profit, we mean the profit is more than expected, is greater than the total cost, more than expected. It's unusual, basically. So that's what we mean by supernormal profit. So it is arrived at by deducting your total cost from your total revenue. And what you have left when it is more than usual, greater than usual, that's the profit, then we call that supernormal profit. So each time supernormal profit is a case in a particular industry, then that will make firm in other industry to come into that industry and operate. It will spring up the inflow of firms into that industry where supernormal profit is being made. So another word for supernormal profits, basically, we can call that positive economic profits. And instances in which you can have supernormal profits being made is the case of where there are barriers to entry into a particular market. Or let's say a firm operates on a large scale, or perhaps peradventure due to invention and innovation of a particular product or production processes. So, being the only business that produces that particular product, or that invented such a particular production or line or processes, then such a firm will make a supernormal profit. We are going to come back to talking about the selling environment in which any of this could be obtained. But I hope you all understand what supernormal profit basically. So it's mostly made by a monopolist. That's a single seller having many buyers. But I'll come back to talking about all this. That's regarding the market situation or selling environments in which any of this could be obtained. So I hope that is good. So understood. Good. So supernormal loss. Supernormal loss also means abnormal loss. It is the unusual loss that is made by a business organization in a financial year. So it is the loss that is beyond the expected loss in a financial year. So let's say, for example, because every business organization usually have normal loss, but when the loss is beyond expected, it's beyond normal, then we call it supernormal loss or abnormal loss. So, and the loss for every firm is often written up to the income statement as expenses. So, this is what we mean by supernormal loss. Let's say the loss estimated by the management accountants or by the economists of a business organization is 5 million naira in a financial year. And the business ends up incurring loss of, let's say, 20 million naira. So the difference between the actual loss made and the estimated loss, which the management had estimated that, okay, this social financial year we're going to be incurring social loss, then the difference between these two, which is 15 million, is considered the supernormal loss. So supernormal loss, to arrive at that or to get that, it is the difference between total costs and total revenue. So when your total cost is greater than your total revenue, then what you have left is loss. But when the loss is more than expected, then we call that supernormal loss. And in any market situation, or let me say sector or industry, that supernormal loss is the case, it will lead to all the firms, almost all the firms, exiting that industry for another industry where there exists supernormal profits. And instances in which you could have an industry making a supernormal loss could be, let's say, rigorous competition from international or interregional, let me say, firms or competition. You could have a case of, let's say, rising in the prices of factor inputs that were employed into production, cost push inflation. Also, double taxation could also be one of the reasons a business could incur supernormal loss. So it will lead to almost all the business, all the firms in that industry where this is the case, to keep exiting as long as there is principle of free exits in that particular sector or market. So the firms will start leaving that sector where there exists supernormal loss. So I hope that is understood. So supernormal loss, I repeat, is the difference between total cost and total revenue. So when your total cost is greater than, is more than the total revenue in a way that is unusual, then we call that supernormal loss. Then last but not least, we have normal profit. So normal profit simply means zero profits. It's the case of when a business breaks even, because in economics, we usually say a business breaks even when such makes normal loss. That means your total revenue exactly equals your total cost. That's basically what we mean by normal profits, and it simply means zero profits. So when a business makes a normal profits, what that simply means literally is that the business is barely doing well, and the owner of the business, when he or she makes a normal profits, will be undecided whether to, continue to stay in that sector where this profit is made, or move its resources to other sector where there exists supernormal profits. But what it basically means is that the the firm is able to cover all costs of production when a firm is making normal profits, including the opportunity cost of resources that were employed into production, perhaps implicit cost basically. So it means the firm is barely doing well. That's what it means. So normal profit simply means zero profits, no profit, no loss. That's basically what it means. So let's talk about the selling environment in which any of this could be obtainable. So there are two basically selling environments or market situation. We have the perfect market and the imperfect market. For the perfect market, that's a firm that operates in a perfectly competitive market. Such a firm will make either supernormal profits or supernormal loss in the short run, depending on what the firm is able to produce and sell. So if as a firm in a perfectly competitive market, if you're able to produce more and sell more in the short run, that's at the beginning of the business, while you're starting the business, you are going to make supernormal profits. But as a firm that operates in a perfectly competitive market, if you're able to produce more and sell less in the short run, you are going to make supernormal loss. That's basically what it means. And in the long run, for a firm that operates in a perfectly competitive market, such a firm will make normal profits. And normal profits simply means, like we've talked about, zero profits, no loss. So that's basically that. Then other selling environment which are considered as imperfect market. And the case in the case of that, we have monopolies, we have monopolistic competition, and we have oligopoly basically. Then remember that all these that we've mentioned, they are all faced with a downward sloping demand curve, and we often regard them as price makers. They have the capacity to have fixed price tag to their products at their own advantage. So, be it a monopolist, a firm that operates in a monopolistic competition, a firm that operates in an oligopoly, each of these firms will make supernormal profits, both in the short run and in the long run. Because for a monopolist, there are barriers to entry. So the firm is considered the industry itself. For a monopolistic competition, that's a firm that operates in a monopolistic competition market. Such a firm, as long as the firm is able to avoid commoditization, sameness of products, then the more the firm will have the capability to have fixed the price of to its products at its own advantage or at which the firm wants to sell. So every firm will always want to sell at a very higher price as long as your products that you produce is being differentiated from other products in the market. So it's unique, and anything uniqueness means you have to pay a huge price for that. So a firm in a monopolistic competition will also make supernormal profits, both in the short run and in the long run. And the same with if oligopolies, that's a firm that operates in an oligopoly market. It's often regarded as competition among the few. So they collectively determine their price as well as output. A good example is OPEC, basically. So they will continue to make both in the short run and in the long run supernormal profits. And that's basically with respect to the selling environment in which any of these profits could be obtainable. So I hope that is understood. So now that you've understood all these terminologies, then let's talk about profits extensively now. So like we did say, profits means the financial gain a business realizes from merchandise, and that's from buying and selling, or that an individual realizes from investment, which I did say the investors will often refer to as return on investment, basically. So to get your profit is the difference between total revenue and total cost. So with respect to profits, there are two schools of thoughts that let me say, that have a business with respect to what profit is about. Although basically management science students, So that's the accountant and the economist. So those two professionals, they are on the same page on as regards what should constitute or what should make up total revenue. So by the two schools of thought, they said total revenue should be uh, price of that commodity multiplied by the unit sold. So you are going to arrive at your total revenue. But as regards total cost, they seem not to be on the same page. They kind of have a divergence of view, different views on what should make up total cost. So to the accountants view costs as money costs. And money cost to the accountants also means explicit cost. So explicit cost to the accountant simply means those costs you incur on resources that are introduced into the business from outside. So let's say, for example, at Echo Plaza Boy, let's say, excuse me, this duster here, it's one of our resources we use in everyday teaching. Our students from far and near and all that. So these resources, we got it from outside. So the money we spent on getting this is called explicit cost. So any resources you introduce into your business from outside, the money you spend on all those resources are called explicit cost. And that's what the accountant regards as total cost or cost of production, basically. So examples of explicit cost, you could have material cost, you could have labor cost, you could have fuel cost, you could have machinery cost, you could have equipment cost, any cost of advertisements and all that. Those are explicit costs to the accountants, which the accountants regarded as total cost of production. So to get the accountant's profit, it is the difference between total revenue less total cost, which is basically explicit cost. That's that. So you're going to get the accounting profit by that. This less your explicit cost. And to the economist view cost has that's so when the economists say cost, basically they mean opportunity cost. I did emphasize that in my previous videos that each time economists they say cost, they mean opportunity cost. So the opportunity cost or the total cost to the economist is the addition of both the explicit cost and the implicit cost. So the implicit cost simply means the cost of capital or the opportunity cost, basically. So each time you hear implicit cost is the same thing as the opportunity cost or the cost of capital or the cost of owner's equity into the business. And when we say implicit cost, we mean those the opportunity cost of the imputed resources of the owner of the business into the business. Now, this is basically what we mean by that. As the owner of the business, there are some resources that you own and you are using them for your own business. The opportunity cost of all those resources are going to be factored into the total cost of production as regards the economist's perspective. So let's say, for instance, as the owner of the business, I have, let's say, a building. And that building, I do not rent it out. I am using it for my home business. If I had rented it out, I would have received rent for the month or for the year. That rent, which I am not receiving, I will factor the cost of that rent and less it from my total revenue. That's what it means. And it will kind of reduce my profits to a large extent, basically. Let's say also I have let's say $10 million and I invested that amount into my business. Now remember that if I had lent that money out to or let's say an investor or a potential borrower, I would have received interest for that money. But the interest which I'm not receiving for investing that money into my business, I will factor the cost of that interest and deduct that from my total revenue. And that will reduce my profit further. So Also, let me say supervision services, which I often render to my business because I own the business. I will supervise my business, making sure that everyone is doing the right thing and all that. All those supervision services which I'm rendering to my business, if I had rented it out to another business, I would have been paid wages or salary. That's wages which I ought to have been paid, but I'm not being paid. I will factor the cost of it, then deduct that from my total revenue, and that will give them my profit as an economist. So implicit costs could include implicit interest, implicit rent, implicit wages, implicit salary. So the cost to the economist now is the addition of both explicit, which the accountant considers as the total cost, plus or together with implicit cost. Then that will give us the total cost to the economist, and that will be deducted from the total revenue. And with that, I will get my profit for the economic profit or for the economist. So always, the profit of an accountant will always be greater than the profit of the economist because the economic profit includes implicit cost, or the accounting profit does not include implicit cost. It only includes or factors in explicit cost. So we've done a video of that. You could go watch that, and perhaps you come back to watching this. That's accounting profits and economic profits, basically. So that's with respect to uh, the two schools of thought that shed light on what should make up the total the profits of a business organization. And with respect to that, we've been able to talk about what the views are regarding what makes up total revenue, which I did say the two schools of thoughts are on the same page, but as regards total cost, they are not on the same page. So being an entrepreneur, the economic reward for pulling factor inputs, that's the factors of production for meaningful production processes, is profits. That's at the end of the financial year. As an entrepreneur, you will expect your business to be profitable, to make a profit. But at the same time, a business could also run at a loss or could operate at a loss, or better still, the business breaks even. So to the economists, they usually, even the accountants as well, they usually measure the performance, the success of every business in terms of profits. So the more profits a business makes, the more healthy the business is, the more successful that business is, and the more the going concern of that business is assured. Going concern in the sense that the business operation will continue to the business will continue to operate till foreseeable future time. That means there is no external threats that could stop the line of the business from going on and on and on. Because I've emphasized before now that businesses are seen as artificial person. They are often being given birth to, then they will start growing and growing. Some will die in the process, and some will continue to get bigger and bigger and bigger. And before you know, they become viable. That's independent, financially independent. So, as an entrepreneur, you may not always operate or make a profit. Basically, you could also, operate at a loss or incur loss, basically, or better still, you could break even. That means no profits, no loss. That's that. Now, I have two important concepts which I'll be explaining using the concept of profits. The first one is the business life cycle, and the second one is the profit maximizing output of a firm. It's very important to pay attention and get to watch the video to the end, because these two concepts which I'm about to explain form the nitty gritty of microeconomics as a field of study. So you've just got to get the gist of the explanation, which I'll be giving in a second or two. So, with respect to profits, I did say a business will either make profits, loss, or break even. So we are going to be denoting that with the concept of total revenue and total cost approach. And with this, I call it business life cycle. Business life cycle, a business will be given birth to, that's born. Then after a while, the business will be enjoying some advantages. That's what we call economies of scale. Then at a point in time, the business will experience some disadvantages, which is diseconomies of scale. Then if the business is able to cut all irrelevant costs, then with that, the business will attain efficiency. Then more cutting of irrelevant costs to make the business to be financially viable. And with that, the business going concern is going to be assured. That means the business will be able to operate till foreseeable future time. So with this here, that's using total cost and total revenue approach to determine the business life cycle of the business. So here, I have from the origin, these are total revenue curve or slope. That's the blue curve or line you have. Then we have this red line or curve to be our total cost. So I did say here, now that you've understood all this, then you'll be able to get the gist of all that I'm about to explain here now in a second or two. So this total revenue curve you have, the total cost lies above it. That means it's above the total revenue. So anytime, like I did say here, when your total cost is greater than the total revenue, then that's going to be loss for a firm. We can say it's a normal loss if the loss is so huge. So this region, from this origin to this point of intersection between total cost and total revenue, is the loss region. Then at this point, they are tangential. That's the total revenue and total cost. They are tangential. They meet. They are the same here. So where total cost and total revenue are the same, we say the firm breaks even. And that's what we mean by normal profits, basically. So the business makes normal profits here. So normal profit, like I did say, means zero profit. It means your total revenue is exactly equal to your total cost. That's basically what we mean. So here, the break even, the firm breaks even. Then above this point, that's any region above the break-even point, is profit region because our total revenue lies above the total cost. So anytime your total revenue is greater than your total cost, then the firm makes profit. So any region below the break-even is called the loss region. And any point or any region above the break-even point is a profit region. So this is a business life cycle. Let's say, for example, a business that operates in a perfectly competitive market. We make loss in the short run or supernormal profits, basically. You can say, but the assumption is that the business makes a loss because the business was only able to produce more and sell less. That's with respect to this. But the business could also break even first year of operation. But for a firm that operates in an imperfect market, basically, let's say a monopolist, we always make supernormal profits, both in the short run and in the long run. That's that. So this is the business life cycle. How a business is started from making a loss to cutting irrelevant costs and breaking even. Then after which, if further irrelevant costs are reduced, our costs are minimized, then the firm will begin to make profits. Then with that, we could say the business is financially viable. That means the going concern of the business is assured. That's that. So this is basically with respect to the first approach as regards explaining the concept of profits. So using total revenue and total cost approach. Then the second approach is using marginal revenue and marginal cost approach. And this is also very important concept in microeconomics as a field. And what this concept is about, very interesting concept, is that Every firm should know the outputs that it must produce to make the most profits. That's to make the highest profits. So this concept is about determining the profit maximizing output of a firm. That means the outputs that you should produce that will make your firm to make the most profits. Now, the rule says, or the principle says, that the profit maximizing output of a firm is where marginal revenue equals marginal cost. So at that output where marginal revenue is equal to marginal cost, profit will be the most high there. But remember, we are not we are trying to maximize the difference between total revenue and total cost. So at the output where marginal revenue equals marginal cost, if you check the relationship between total revenue and total cost, which gives us profits or loss, but it's profits now because at that output where MR is equal to MC, total revenue will be so higher than total cost that profits will be the highest at that output. So the profit maximizing output of a firm is where MR equals MC because at that output, profit is always the highest. It's always, the biggest for the firm, basically. And that should be the output that the firm should produce. Now, let's explain it further. Look at this. So let me shed the light on MR and MC a little so that it will further your understanding of this. So marginal revenue means the additional revenue for producing one more unit of a commodity. So when I produce one more unit of a commodity, what I get or the revenue I get as a firm is marginal revenue. So let's say our marginal revenue is, let's say it's 5 naira. Then also marginal cost, on the other hand, is the additional cost a firm incurs for producing one more unit of a commodity. So when I produce one more unit, the cost I incur is marginal cost. So let's say that is 2 naira. So here now, marginal revenue is greater than marginal cost by 3 naira. So at this level, the firm is advised to keep expanding by producing more output because the more the firm produces, as long as MR is greater than MC, it will increase the profit level of that firm. And with that, profit will keep increasing and increasing. So the firm should continue to expand by producing more as long as MR is greater than MC, up to the output or up to the point where MR is equal to MC. So where MR is equal to MC, profit will be the highest at that output. That means total revenue will be so greater than total cost, and profit will be the highest at that output. So when MR is greater than MC, the firm is advised to expand. That means the firm should keep expanding. So when MR is greater than MC, the firm is advised to expand. Expand by producing more output because the more output the firm produces, the more the profits of that business will also increase. So let's depict this principle with the concept of these, with the help of this graph. So every firm will love to produce at the minimum point of the marginal cost. So this is the minimum point. This is our marginal cost. It's U-shape. This is our our average total cost, and this is our marginal revenue. So we are illustrating this using perfect markets as an instance or as a balance. But is applicable to all selling environments, be it a firm that operates in a perfect market or in an imperfect market. So the rule is intact, is the same for all selling environment. The profit maximizing output is where MR equals MC. So these are MR, and in a perfectly competitive market, your MR is the same thing as your price. They are the same. So AC, that's average cost, is U-shape, and your MR cuts your average cost below its minimum point. This is the minimum point of the average cost. So MR cut it at that point. So like I did say here, that every firm will love to produce at the minimum point, at the lowest point of the marginal cost. So this is the lowest point of the marginal cost. So let's assume here marginal cost is 2, and at the output, let's say the output is 50 units. So let's assume our price, which is our marginal revenue, to be 5. So like I did say, as long as marginal revenue, which is the same thing as price, is greater than marginal cost, the firm is advised to expand by producing more output, and the more profit for that firm. And that's as the firm expand, as long as MR is greater than MC. So these 50 units here is not the profit maximizing output of the firm, because marginal revenue is greater than marginal cost by 3. So the firm will expand by producing more. So let's say the firm expand to producing here. Let's say this is 200 units. So if we trace our marginal cost here, this is our marginal cost. So if we trace it here, let's say this is 3. So marginal revenue is still greater than marginal cost by 2 naira. So the firm is advised to expand by producing more, and that will increase the profits of the firm. So this output, which is 200 units, is not the profit maximizing output, because the marginal revenue is still greater than marginal cost. So the firm is advised to expand. So the firm expands to producing, let's say here, so the firm expands to producing, let's say 300 units. So at this point, you will see that our MC is tangential, is meets the marginal revenue. So MC here is 5 naira and MR2 is 5 naira. So at these outputs, where MR, which is horizontal, parallel to the output axis, is tangential or intersects the marginal cost curve, then this output is considered a profit maximizing output, where profit is the most highest. That means total revenue seems to be much more greater than total cost, and profit is the highest at this output. So 300 units of output is the profit maximizing output of the firm, because at that output, marginal revenue equals marginal cost. So I hope this is understood. So this is basically what we mean by that principle of using MR and MC. Now, let's go it further. Look at this. MC is now greater because it's rising. MC is greater than MR. Let's say here, MC is, let's say MC is 7 naira. So let's say at these outputs now, let's say this is 350. So as long as MR is equal to MC, the firm should not the firm should produce at that output and not expand further. If the firm decides to expand further, it means MC is greater than MR. So each time MC is greater than MR, the firm is not advised to expand. So MC greater than MR, don't expand. Because as a firm, if we expand by producing at that output where MC is greater than MR, it will increase the loss of that particular firm, because the additional cost of producing one more unit is greater than the additional revenue for one or for selling one more unit. So that's basically what this means. So if a firm decides to produce at these outputs, which is 350, where MC, which is 7 naira, and MR, which is 5 naira. So MC is greater than MR by 2 naira. So at these outputs, where MC is greater than MR, the firm is not advised to expand, because if the firm produces these outputs, what that means is that the profit of that firm will reduce, and it will increase the loss of that firm. That's basically what it means. So the rule says the profit maximizing output of a firm is where marginal cost equals marginal revenue. So one thing more, in a perfectly competitive market, we have emphasized that your price is equal to your MR. So this is basically what we mean. So MR is the same thing as price. So we can say the firm should produce at that output where MR is equal to MC. That's the principle. Then for a firm that operates in an imperfect market, we can also say that MR must be equal to MC. What I'm just trying to prove is that in a perfect market, price is equal to MR and MR is equal to AR. So whether a firm in a perfectly competitive market produces other output where price equal to MC or MR equal to MC is the same. That's basically that. And for a firm that operates in an imperfect market, the firm should produce at that output where marginal revenue equals marginal cost because profit will be the most high there. That's at the output. So this is basically what we have with respect to the concept of profit. So in our subsequent episode, we are going to be looking at practical questions on the concept of cost, revenue, as well as profit together. So this is where we're going to be drawing the curtain for today. Thank you for the time. Keep supporting us. Like our video if this is the first time you are watching our videos. Subscribe to our YouTube channel if you haven't subscribed to our YouTube channel. Continue to help share our videos to friends and relatives whom this video might be of great help to them. And what more can I say? I wish you all an excellent and beautiful journey in your academics. Do have a good one. Bye bye. I'll see you on my next episode. Do have a good one. Bye bye.